Welcome back to another episode of Hoot and Poop. So I hope you like all the previous videos on options. All right, so today I will be covering up the last part of my introduction of optional. All right, so today I will be talking about put options. Okay, now, so what is put option? If you guys can recall, okay, basically there are also a buyer and a seller in the put option. And as you can see, my friend Freddie is the buyer and Nancy is the seller. So just to do a recap, being a buyer, you have the right to sell the shares at the agreed price for person owning the contract of a put options. Now, being a seller of a put options, basically you are obliged to buy the shares at the agreed price. Okay, just remember this case, okay? Now, being in a put option situation, generally, my own strategy or the way I see it is that put options are more of a protection bias, meaning to say, okay, I tend to, be the seller of the put contract. Okay, so how does it work? So being a seller is that number one, when you choose the agreed to sell the put contract at the agreed price, if the share price, okay, at the end of expiry is higher than the agreed price, you keep that money that you've collected, right? Remember, seller, you collect money, you collect premium, right? Money from the buyer. So if the share price at the end of the expiry date is lower, or rather is higher than the agreed price, you do not need, there's no obligation that you need to do whatsoever, you keep the money immediately. However, if the share price is below the agreed price, okay, there is almost 100% chance that being a seller, you need to buy the shares at the agreed price. Okay, so this is the, of course, there's pros and cons for this, but generally I term this as more of a protection bias, which I'll explain to you later in the video. Okay, so before I go into the reason of why it's a protection bias and so on, all right, let me just give you an example or to understand how the premium and the calculation of the whole contract is like for a put option. So let's use the same example as assuming Facebook is $100 today. Okay, so being a buyer, let's go for the buyer of a put contract. All right, take note. The contract is a 1 month duration. Okay, so the strike price or the agreed price is $100. Okay, being a buyer, you need to pay the premium to the seller. So you pay $5 to the seller. Okay. Now, if the share price of Facebook dropped to $50, so what's the worth of your contract? Now, remember, for put contract, it's kind of like the opposite of share of call contract. So for put contract, the worth of your contract, to calculate the worth, is you just take the strike price or the agreed price minus the share price at expiry. So for this case, the agreed price or the strike price is $100 based on your initial contract. The share price is $50. So the worth of your contract is $50 if you are a buyer. So your profit and loss after you deduct the premium you paid to buy the contract is $45. And of course, on the other end of the spectrum, the seller, he will lose $45 as well. Now, if the share price of Facebook stays at $100, it means there's no change. What's the worth of your contract? You first take, the strike price or the agreed price of $100, which is here, minus the share price of $100 as of expiry. The worth of contract is $0. So because of that, your profit and loss is negative $5. Why is it so? Basically, you just lose the premium that you paid for the contract if you're a buyer. On the other hand, the seller will earn $5 immediately. Now, if Facebook's share price went up, $150, the worth of your contract is you take the strike price, which is the agreed price of $100 minus the share price of $150, right? It's the contract worthless is $0. So therefore, your profit and loss for this case for a buyer of the put contract will also just be the premium that you paid. That means your loss is just $5 and the seller will earn $5. So if you can see from this example, right, basically you can see that, being a buyer of a put contract, you are actually betting against the market, because let's assume that the stock that you choose is a fundamentally good company stock where the price will go up in the long run. Okay, but if you choose to be a buyer of a put contract, okay, if the share price goes up from the share price when the day you buy, okay, you are making a loss. So basically, being a buyer, you are actually having a bearish view of the market or the stock. Okay, so and if you look at it, right, being a seller, the only time when you will lose money, okay, based on my 3 examples, is when the share price drops below the share price or expiry drops below, all right, the share price that you buy the shares. Okay, so this is how it works for the put contract. Now, of course, if I were to draw a comparison from the call contract, for being a call contract, okay, when you are a buyer of the call contract, you want the share price to go up. So this is the difference between a call and a put contract. Okay, now for me personally, I do pretty much a lot of sell puts. I mean, being a seller of the put contract, and there are a few conditions that I actually look at. It's not really stated in this video, but I just want to highlight some of the conditions that you have to look into it. And then if there's enough interest in it, I will do a video on some of the conditions that I actually look at it before I carry out any sell puts. Okay, that would be a little bit of technical, so I do not want to bombard it with today's video. Now, there are 2 things that you need to look at when you do a sell put and the condition. I mean, 2 main things. Number 1, what is the agreed price? And number 2, what is the duration of a contract? Now, for the agreed price, you can choose whether, generally for me, I usually choose where the agreed price is equals to the share price when I carry out the contract, or the agreed price is lesser than the current share price. The reason is because if the company that I'm looking at, for example, Facebook, now I think probably is trading around 300 plus. If I feel that at 300 plus, Facebook is still undervalued, all right, or it's at fair value, then I may choose to sell my put contract where my agreed price is equals to the share price. Or on the other hand, if I feel that Facebook today, where the share price is a little bit expensive, like 300 plus is a bit too expensive, and if I feel that Facebook's fair value is around $250, so I may then, for this case, choose a agreed price that is lesser than the share price. So everything boils down to what is your valuation for the company. Okay, not to worry. Throughout the whole course of my whole video, I will also touch on a little bit of valuation, because I think this is something very important for every investor to know. Now, as moving on to the duration of contract, so generally speaking, being a seller, okay, because you're obliged to carry out some clause. So for this case, being a seller, you're obliged, being a seller of a put contract, you are obliged to buy the shares if the buyers decides to exercise it. So most of the time, okay, you are obliged to buy the shares if the current share price, or rather if the share price at expiry is lower than the agreed price, then you have to carry out the obligation. So most of the time we want the money to be in our pockets as soon as possible, and so that we can reduce the duration of our obligation. The shorter the better it is. So that's why for me, when I carry out my contracts duration, when I sell put, I try to sell the duration, a shorter duration, the better it is, or in some technical terms, it's called the nearer to the expiry date of the contract. Okay. Now, just want to highlight another important, very, very important point, which I have actually talked about a couple of times in this whole video, is that because, for example, okay, this may be the agreed price, or rather this may be the strike price or agreed price when you carry out the sell put condition. But on expiry, the share price drops below the agreed price, for example, and it is possible to happen. Okay, so for this case, you are obliged to buy the shares at the agreed price, even though the share price currently today is lower than the agreed price. So this is something that I need to caution everyone, and which is why the mindset when you carry out a put options trade have to be very, very clear. When you go in with that agreed price, you must know that number 1, this is the price that you are willing to buy. It means to say you must have enough cash to buy the shares. And number two is that this is the price where you deem it as fair value or lower than fair value. Because of course, we can't actually, time the market to see whether will the share price drops below the price that we buy, or will the share price goes up higher and so on. But if the company that you choose is a fundamentally strong and good company, over time, the share price will catch up with the performance of the company. So if you deem that this price, when you exercise your trade, whether when you carry out your trade, okay, is the fair value, and you carry out the sell put trade, and if the share price drops below, it's okay, because this is still your fair value. And at the end of the day, in terms of long run wise, the share price will go up higher, assuming the fundamental of the company is good and strong. Okay, so quick summary, just take note for a put contract, right? Being a seller, you want the share price to be higher than the agreed price. But being a buyer, you want the share price to be lower than the agreed price. And this is why, right, put contract to me is more of a protection bias, because I tend to be a seller, and I always try to sell it where it's at fair value or lower than fair value. That's how I do it for my strategy in terms of a put contract. Okay, so with that, I come to the end of my put contract. So it may be very heavy in terms of the content for those people who have never tried before options. So please go and revisit my video again. And if you have any questions, do leave in the comments below, and I will look through all of them and I'll comment to them, or rather I'll reply to them as soon as possible. Okay, so I really hope that you can like and subscribe to my video channels, and do let me know if there are any other contents that you wished for me to share about in the future. Now, rest assured, okay, this is just a very, very, very preliminary introduction on what options all about. I will have to go in depth deeper, and it will be covered in the subsequent video. Okay, so with that, I'll see you in your next video. Invest safe.